My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it.
Jim Cramer, the high-energy host of Mad Money since 2005. Think about that. On TV with a net worth of $150 million. Now, you might have heard him before. He shouts a lot on TV.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica.
But is he really a financial guru or simply a master showman? Hi, this is Marcus de Maria, a multi-millionaire stocks and crypto investor who was once more than £100,000 in bad debt. So if I can do it, you can certainly do it. Let's talk about Cramer's journey. And how did he get from Harvard to Wall Street? Well, I'll tell you how. First of all, going to Harvard cost hundreds of thousands of dollars. So he faced hefty tuition bills, and also his father, this is terrible, lost the family fortune on stock tips. He basically looked at the newspaper and just got into things that didn't work. I mean, it's not a strategy, is it? So Jim had to turn to stock market to make ends meet. He actually said, well, I guess I need to learn how the stock market works in order to get my family out of this. So it's interesting, right? He had to do it. Interesting. When the back's against the wall, I guess. So let's talk about some of his successes. In '87, he founded the hedge fund Cramer & Co., where he achieved, listen to this, 24% annual returns over 14 years. That means he averaged 24% a year over 14 years. That's pretty good. I have to tell you, that's pretty good. That is right up there with the likes of Warren Buffett. And it also means that he took home $10 million a year and more, which isn't bad either. $10 million a year, thank you very much. But even better, he co-founded TheStreet.com, which is like a financial news channel worth $1.7 billion. So think about that. If he only had 10% of that, he would have made $170 million, right? And then he turned to Mad Money, which is on CNBC or something like that, since 2005. So he's been on TV for over 20 years as well. But here's the question. His portfolio has often underperformed the broader market. So is he just a showman? Some people, some researchers call him a crazy man that just shouts and shouts and shouts that you shouldn't really follow.
It's like this, remember, it didn't go all the way down because it like fell on something, you know, and it still had the solar coming on it. Yeah, I call that a success. Give me the tang.
Really? Well, before I answer that, let's dive into his investing philosophy. After all, he is worth $150 million. He must know something, right? So let's have a look at his investment philosophy. Number one. Do your homework. You need to understand the company's fundamentals as much as you possibly can. So research, research, research. In fact, he says, try and learn as much about the company where if you had to explain it to somebody else, they would invest. So when you go into a company, can you actually explain it, why you're going into a company in a way that would convert somebody else into it? Do you actually do that, or do you just jump into companies? It's an interesting one, right? Second, diversification. I'm sure you've heard this before. Don't put all your eggs into one basket, right? Now, he says that there is always a bull market somewhere, and we promise to try to find it just for you. That's how he starts and ends every single show.
There's always a bull market somewhere, and I promise to help you find it.
And I love that because think about it. If there is a market going up somewhere in the world, there's one going down somewhere else. And conversely, if somewhere in the world there is a bear market, there's bound to be a bull market somewhere. So you do need to be diversified in different stocks, different sectors, different markets, but also different geographies as well, which I think is absolutely right.
You know why you need to stay diversified? Because of darn days like today, where the Dow advanced 244 points, closing above 41,000 for the first time ever. But the S&P plunged 1.39%, and the Nasdaq plummeted 2.77%. If you only own the big tech stocks that we talk about so much, the ones that have been leading this market until a week ago, let me tell you something. This day might make you want to give up on the entire asset class. And I bet some, if not many, will do exactly that.
To give an example, in 1987, as you know, there was a massive market crash, Black Monday, right? 1998 and 2008, the entire markets fell sharply. However, Cramer argued that by carefully selecting specific types of stocks, it was possible to make money even in those difficult years. Like he says, there's always a bull market somewhere. So, for instance, buying cyclical stocks in 1987, bank stocks in 1998, and consumer goods in 2000. Why? Because it was a technology bust, right? And tech stocks in 2008, because it was a financial crisis, would have been profitable decisions. So there's always a bull market somewhere, and I love that. Absolutely love that. Something else that he talks about is timing the market. Timing. That means both getting in and getting out. So for example, capitalizing on whatever trends that there are, getting in at certain points. Now, look, this is not easy at all. People oversimplify this. So he's not saying, time it exactly, and you might be. Remember, we did a video on Jim Rogers, and Jim Rogers is normally around 12 to 18 months too early, and he admits it, right? But it doesn't matter, he says, because if it goes against you, you can just get in again. So Jim Cramer, though, is much more kind of short-term, really, than he is long-term, and so he likes to trade the market. Not surprising, he had a hedge fund, right? This is what hedge funds do. Hedge funds, remember, hedge themselves. In other words, you will be long one position, but you will be short another position. So they really are trying to time the market. But on the other hand, Jim Cramer says don't be over-ambitious either. And he says use stop losses in order to limit your losses as well. So he really is much more of a trader. Let's go into a little bit more detail into his diversification strategy. Because remember, that is all about spreading the risk. Now, he personally invests in a variety of companies, whether it's blue chips or high-growth startups. I mean, you couldn't get more different than that. Next, he talks about being adaptable, right? Well, obviously, if he's investing in all these different things, but he says change your portfolio depending on the market conditions because markets do change. It's a typical hedge fund. Also, avoid being too greedy. He says bulls make money, bears make money. He's a hedge fund, right? So he would do both up and down. But pigs get slaughtered.
Patience is a virtue in this business. If you have a reason to believe in a business, don't dump its stock just because it's not getting any traction for the moment. Sell. You're not a hedge fund manager, for heaven's sake. You don't need your positions to show a gain every quarter or every month or even every day. You don't have any investors who are going to pull their money out from you because one particular position is taking too long to pay off. So just indulge yourself. You can afford to wait for these stories to play out. I say this because you will be tempted to sell even best-of-breed stocks if they don't do something in a short period of time. You may correctly identify value, but this market can make it very difficult to stick to your guns, even with something you truly believe in. When you own a stock that's going down, you're going to feel compelled to give up on it. But in many cases, if you've done your homework and you have conviction in the underlying business, that urge to sell will be a mistake.
So don't let emotions cloud your judgment. Stick to your plan, whatever your plan is, and be adaptable. It's really interesting because his strategy is kind of all over the place, but follow a plan. Next, he says, don't fear taxes. A lot of people don't do things because of taxes. That's like the tail wagging the dog. First of all, it's a business cost and you have to pay anyway. And let's focus on making money in the first place before you start thinking about taxes, all right? So don't say, I'm not going to do this strategy because I have to pay too much tax. That's ridiculous. Let's make the money first. Next, he talks about being patient. So avoid trying to perfectly time the market. He just talked about, well, yes, we need to time the market, but not perfectly, right? You're never going to be that person that gets in at the bottom and gets in at the top. And if anybody promises you that they can teach you a technique to do that, they're lying. Run like crazy. So, should you listen to Jim Cramer? Because Cramer's picks have really underperformed at times. A lot of the time. Why? Well, really, because he's on television. So for instance, on August the 8th, 2008, Cramer recommended investing in bank stocks. In 2008! That is ridiculous. That's right in the middle of the financial crisis. And this was, during the financial crisis of 2007, 2008. I mean, that's like, hello. But listen, nobody gets it right 100% of the time. Also, he has a very short-term focus because think about it, the fast-paced nature of live television can necessitate really quick decisions and a focus on short-term trends to make it relevant, right? But this might not align with long-term investment strategies or any strategy, actually, because, it's an entertainment factor. And that's the second point. It is entertainment. It's a show. Cramer's show is often focused on creating engaging content. And that can sometimes be prioritized, entertainment over rigorous analysis. So the two don't really go together. So I don't blame the fact that he's got a show and talking about stocks and the fact that they don't really work. That's why when he ran a hedge fund, he was averaging 24% a year. Yeah, that worked. And the last point is why I forgive him is because of economic cycles, because different market conditions favor different investment strategy. And a strategy that works well in a bull market might underperform in a bear market. And all this in front of a camera, trying to keep people entertained. I just think hedge fund, he did really well. Entertainment, not so well. I get it, right? So here's some key investing lessons. I'm going to do a little bit of a summary, but also maybe put some new things in there as well. So one of the things he talks about is start investing early as you can, so that you compound your money over time. You're not going to make $1 million or 150 million like he does over 1 year. He made it over several years. Next, have a clear plan. Remember, he said, don't get greedy, stick to your plan. Remember that? So you need to have goals, and you also need to have exit strategies. Now, what we tell people is you need to have 5 things in your plan. Remember, you need to know what to invest in. You need to know at what price you're going to be investing in. You need to know how much money to allocate. And you need to know how to get out with a large profit and how to get out with a small loss. So you need at least 5 things in your plan, okay? Then, a big one, he talks about diversification. There's always a bull market somewhere. Diversify, whether that's geographically or whether that's different strategies or whether that's different equities. Do your homework is a big one for him. Remember, he said that you need to be able, when you get into a stock, to actually explain it to somebody else, and they will then change their mind and actually invest in that stock. So you need to have a thesis, right? Next, don't panic during downturns. It's totally normal. Markets go down. Sometimes they crash, but they do tend to recover. So don't panic and just sell. Don't get emotional. Next, buy high quality companies. Remember, he talks about doing your fundamental analysis and only getting into really great stocks. And a quick summary really is look for opportunities in all markets. Why? Because there is always a bull market somewhere, and he in his show is always looking out for it. I would use his show much more, not as a verbatim thing to invest. I would use his show as a way of saying, okay, these are interesting picks. Why does he say it? And then do your own research. Remember, do your own research always. Rule number 1. Rule number 2, look at rule number 1. So, up to this point, what is Cramer's legacy? We're talking as if he's dead. He's still out there, but still, he's a very polarizing figure, but has a net worth of 150 million. So he must know something. It's a real story of ambition, success, and passion for investing. And boy, does he have passion, because when you watch his show, it is very entertaining, and he does shout a lot. And that's Jim Cramer. What do you think about Jim Cramer, and what do you think about his investment philosophy? Leave your comments below.
Investors are still concerned about the state of the commercial real estate market. I'm getting a sense of Huntington Bankshares and what the CEO is saying, so I say stay with Cramer.